just as a follow-up to our webinar on asset rotations over the cycle, we had some good Q&A at the end, so I didn't get to my slides that I had in the appendix, but I think, you know, as a supplemental to our webinar, where we talked a lot about the market basically being risk on, thinking the economy is going to do well. If we had time, I was going to show you the appendix just to give you where is the economy right now. Now, so let's look at that, okay? So we're going to look at consumer, all right, investment and jobs, okay? So first of all, GDP growth is more reliant on the consumer, okay? Now that's for the total growth. The consumer is the big gorilla. The consumer is 69% of spending based on the latest quarterly data I had. By the way, just so you know, you can get this data if you want to do it. And the website that I had for this one is FRED. So it's the Federal Reserve, and they have a lot of different charts you can create. Now, I created them, downloaded it, and put it in my colors. But you can get a lot of good economic data to understand where you're in the economy from them. And whereas this, whereas the Fed getting this is from the BEA. So this data I'll got from the BEA. All right, so consumer is the big gorilla. Consumer is a big part of the economy. The consumer is the blue in here. And you can see the consumer contributions to GDP growth has been rising. Now, over 2025, we had some big swings in exports and investments. Businesses spend a lot of money on investments to get ahead of tariffs in the first quarter. Of course, a lot of that investment they had to do by buying things from overseas, so net exports was big negative. And then it flipped around the next quarter. But what you can see, what's been driving the economy recently is basically the consumer getting better. So the key is, will the consumer continue to getting better? Now, this investment is 18% of GDP, but it tends to be very volatile. So the green here, I have nominal GDP growth, and I'm showing you investment spending growth. The investment spending growth has a different scale, twice the scale as GDP. So that means investment spending is very, very volatile. Here it was down 20%, went up, let's say 10%. So it's a 30% change on something that's 18%. Well, 30% times, let's say 20% instead of 18. That's 6% contributions to GDP right there. So it's very, very volatile. So we need to, in order to really understand what's happening in the economy, a lot of people say we've got to know the consumer, but you have to know our business is investing. If business is investing, they need to hire people. They buy stuff in order to invest, to build plants and stuff. So it's a very important part. So let's first of all take a look at the consumer, and then the slide right after we'll look at investment, and then we'll look at what really drives consumer spending, which is jobs. That's the third slide from now. All right, so consumer. Consumers keep spending even though they're not happy. Here's the evidence. So basically what I show you is real PC, real personal consumption expenditures, just units, and the ups and downs. You know, if it's positive, that means it's growing, and you know, negative, it's not growing. And then what I show you is a survey of consumers that are $50,000 in income and up. And it's the annual change. The annual change, the blue, has been negative. That basically means consumers are becoming less and less positive. And they're not that positive, but they're getting even less positive. But for some reason, recently, you see this upward movement. You know, personal consumption expenditures on units have been going up, even though their confidence is going down. You think if they're less confident, they'd be less willing to spend. So how are they able to do this? Okay. Well, a little bit more on this. The blue line here is income, and the black line is personal consumption expenditures, but on a nominal basis with inflation, because income's, you know, with inflation and wages. You can see the black and the blue kind of move together over time. The red is the difference between income minus spending, and what you can see is here, income minus spending has turned negative. That means people are spending more than their, the spending growth is more than their income growth. How are they doing that? Well, they're doing that because the savings rate is plunging. Okay. And by the way, interests kind of stagnated. Why? Because the Fed started lowering interest rates. So savings rate is plunging, which means people are spending a larger portion of their income on stuff. How long can that go on to support the spending, which is a large portion of the economy? And then your question about how long it can go on also resides, but it could be resolved by the fact that delinquencies are rising. The credit card delinquency rates back during the great financial crisis was here, and now they're here. Now, my guess is savings rate going down has resulted in income not being as much as spending. But if they're starting to be delinquent on the credit cards, can they continue to spending? Well, the answer is yes, if the market's saving for them. So maybe that's what's been causing the spending to continue to be positive. And remember, I just showed you spending's pretty important to this good GDP growth we've had. Is the stock market's been saving for people. If we look at the net worth, now net worth is a function of if you're in the stock market, but it's also housing prices and things like that. Net worth recently, the blue, has been growing quicker than retail sales. So where income is growing less than consumption expenditures, the stock market, housing, and whatever else someone may have, that makes up their net worth, minus their liabilities, because this is assets minus liabilities, has been going up quicker than retail sales. And maybe that's given people the confidence in order to spend. But this also means, and by the way, you look over here in the graph, you can kind of see, there is some leads and lags, but a savings rate tends to go up when net worth goes down. Well, savings rate tends to go up in recessions when the stock market tends to go down. So there is somewhat an inverse relationship. Maybe there's some leads and lags I needed to add into there. But it looks like the reason why people are spending is they're not saving as much as their income, and whatever they had in worth, all their assets, has been going up quicker than the retail sales, giving them confidence to spend. That also means if the stock market goes down, it's possible that will have an impact on spending. And if it does, that will have an impact on, obviously, the economy, because consumer spending is 69% of the economy. Okay, let's look at investment spending, because that's what I said is really, really volatile. Now, investment spending is the black line here. And investment spending tends to lag by about 14 months earnings. Now, this earnings is private and public companies in the United States. So earnings growth, which is the left axis, has slowed for public and private companies, and investment spending has slowed. It's around 5%. Now, the 5% is being somewhat influenced by a small part of the investment spending, and that's the IT equipment. The gray line here is the annual change in non-residential information processing equipment. You can see it's really spiked up. This is all of our investment in AI, okay? How has that impacted the overall GDP? Well, gross investment, non-residential information processing equipment was about 1.7% of GDP back here. And now it's, it's like closer to 2%. So this has had a positive impact on GDP growth over the last year. Now, but keep in mind, a lot of this IT equipment is imported. So on a net basis, we're spending more money on investment, but we also may be importing a lot of it, which is a negative from GDP growth. So this is not something that can really, create the economy, right? Create a huge amount, because, it's not a large part of the economy. But it is surging. Interestingly, if this surges and it replaces people who work, what will happen to your consumer spending? Well, let's look at jobs here. Job growth is weak, but remember, job growth is not a leading economic indicator. Let's look over here. So the Conference Board has leading indicators, coincident indicators, and lagging indicators. Inflation are lagging, payroll is a coincident. In some of my work, payroll seems to lag a little bit the economy, all right? Or at least to the stock market. So job growth is very weak. This is the change in non-farm payrolls 1 year change. You notice when we normally get to this level, that's a recession, that's a recession. Well, that was a recession. That was a recession, that was a recession. And basically, this is stall speed. It normally results in a recession. And something I also watch is the number of weeks it's taking for people to get a job, which tends to go up. When does it tend to go up? Well, actually in recessions and a little bit after. So that makes me a little worried. But some people say slow job growth could be maybe the US's first decline in the population. That's immigration, okay? Or is it job growth because AI is coming for jobs? Maybe because of AI, it's good we don't have growing numbers of workers because it's not needed. And if we had a growing numbers of workers for jobs and AI is not, we don't need the people, then the unemployment rate could be really rising. But my caveat to all this, so this would be the good thing about AI coming to jobs, that's good if we don't have any workers. But if there's fewer new workers, who will buy the stuff that makes up 69% of the economy, consumer spending? So we got a bunch of things that are kind of moving around here. And, just go back to the intro here. We're talking about asset rotations over the cycle, which are heavily, dependent, coincidence, leading, whatever to the economy. And it's probably important for you post our webinar to have a sense and where we are in that economic cycle with consumer investment and jobs. Thank you very much for your time today, and hope you have a great one.